morning, folks, and welcome to another episode, this time with Felix Frey, where we are going to talk about how and when to trade Iron Condor. Felix, how's it going?
Hey, how are you, Z?
Doing well. A little bit sick from all the move and the atmosphere and the changes and this new thermostat. The Nest thing likes to go fancy at 6 a.m. and then at 8:30 a.m. It's a long story. I'm doing all right. How are you?
I'm doing all right. Just watching this tape hit new highs every day.
It's ridiculous how every day, I saw a tweet somewhere and I didn't get a chance to fully read it, but it mentioned, as we put up the disclaimer, about how if you are a young individual in your 25s or 30s, a market ripping continuously this much might not be the best for you. I assume they said that, assuming because you don't have a chance to buy at a dip as much as, your ancestors may have had the chance to.
Sure, sure. I can see that. It also programs you to think that it always happens.
I'm not saying I'm waiting for the shoe to drop, but I am interested to see how the market would react if and when that does happen. But let's
Exactly.
go ahead and talk about iron condors. We've talked about in the past with directional trading with calls and puts. Then we've talked about how to mitigate some of that risk with putting on spreads, whether it's a call spread or a put spread as well. When should individuals use an iron condor? And before you even answer that, what is an iron condor? If you could just quickly just break that down for me.
Sure, sure. So an iron condor is um, selling a put spread, out of the money put spread, and an out of the money call spread, and doing it at the same time, collecting premiums on both sides, and depending on time and expiration, so that's one of the key factors, and the next factors are strikes. Which ones you use, how far away. So it's essentially selling a call spread, selling a put spread, taking in both the premiums, and
Yeah.
hopefully the stock doesn't get through the strikes that you've chosen, essentially.
Yeah. So my understanding of iron condors when I used to trade them way back when
Yeah.
was pretty much that if I believe that a stock was going to stay within this range during a particular period, that's when I would go ahead and kind of trade them. Do I have that right?
Yeah, in general. I mean, in general, iron condors are going to work in a ranging market. They it's it's a selling strategy. So it's one of these things where people can buy options and sell options and make money with them, and lose money. Okay, but there's two ways to really look at it. You're doing a buying strategy. That's one mentality. Selling strategy is another mentality. Buying is putting up small dollars to try to make leverage bets and take 2-3 times out of it.
Right.
Selling strategies is more about taking it. You're going to win a high percentage of the time, but the market is basically saying that if you lose, that you might lose 4 or 5x, or call it 3 to 7x, however you structure the trade. But yeah, the math is essentially, you're going to win less with buying. You're going to make more with when you win, but when you're selling options, you're going to win a high percentage of the time. But when you lose, you can give back a decent amount.
In what market conditions would you say an iron condor is ideal? What needs to happen for you to be like, you know
Sure.
what, like is it the VIX at a certain point? What's
Right,
going
right,
through your
right.
thoughts?
Sure. So I find that the extremes in the VIX are probably no good, right? So when the VIX is way high, probably not great for iron condors. When the VIX is way low, okay, it's also probably not good because you're not getting paid that much. And especially if it's low and it's a trending market, you can get caught in something that you're not getting paid that much up front. And the stock, if we're trending higher, the stock just goes right up, straight up all day, and you get taken out at the on the call spread, 5x, but you only took in about 2x on the premiums. So uh, the best scenario is usually when there's some volatility. So IV, let's call it above 13, 14, and then also below some level, somewhere, let's call it 25. What usually happens is when the volatility in the market, the IV is above, let's say as it goes to 30, 35, the market's not doing well. It's, it's
Yeah.
coming off, it's moving around. Oftentimes when the higher the IV, the cheaper the actual IV is relative to the actual movement. So it's almost counterintuitive. It's, you would think, oh, high IV, we should be doing this. It's like, usually high IV is not high enough for the intraday. So this is where the math comes in. So IV is calculated on a close to close basis, right? The implied volatility close to close. So if you have a market that is whipping around up and down and closes at about the same range every day, so it's kind of flat, but it's really moving up and down and really jerking up and down each day.
Yeah.
The IV is not gonna contain those moves. It's just going to contain the closing prices. So it's going to say X volatility, XIV. But in reality, if you calculated the real highs and lows where you could get stopped out, or if you have any type of risk management, you can get stopped out on a trade, that's where that's not going to capture that. And so, there's a tendency to sell IV as it goes up. 35, people start buying puts in the VIX or start trying to short the VIX when it goes to 35, 40, 50, because they know it's mean reversion. Eventually it'll come back. But that dampens the VIX or dampens the IV, while the actual internals could still be moving a lot higher. So I think that's very important.
Do you ever end up, I mean, I'm sure, well, let me not put words in your mouth. Do you ever end up adjusting the sides of the Iron Condor as well, whether it's closing and then re-adding or whatever the case may be, or it's nope, all the legs I'm closing at once?
Yeah, it's a good question. I mean, I think that these days there's so many tools to backtest. There's many tools out there to backtest. I think people try to use the Iron Condor as almost like an automated strategy. I'm gonna do this, and zero DTE is very popular, right?
Yeah.
I'm gonna do this every day. I'm gonna start it around 9:30 to 10 o'clock, sell my legs, and then I'm gonna get out at X percentage. And you can go on, and there's millions of ways to do back tests on those. Do I want to go at 9:35, or do I want to sell it at 9:45, 10 o'clock? When do I want to sell it, and when do I want to get out? Iron Condors, usually at the end of the day, that on zero DTEs, the gamma in the option, which means you can win or lose very quickly if you're near the strikes, and it can be in the money a lot, or you can make it all back. So many people do these Iron Condors who have back tested it, who have experience, and I'm telling you from experience, if you hold it till close to 4 o'clock, it can get a little bit dangerous. So the volatility of the P&L increases, because all of a sudden you're in, and then the spreads increase too. So that execution is a whole other issue, right? When you're doing 4 legs, the Iron Condor is a put spread and call spread, 4 legs. If you're not using SPY, Qs, IWM, Apple, NVIDIA, the highest liquidity names, you could be paying too much. And believe me, it's a math game. And if you're doing this consistently over the course of a year, those spreads matter. And it's important to appreciate low bid ask offers. Okay. Yeah. Because that is a cost.
You mentioned zero DTE. Obviously, in the past we've talked about leaps, and 45 days out, or within 45 days, we know about gamma going decreasing as well. What do you prefer in terms of time frames when you're putting on an Iron Condor? How far out do you want the expirations?
I like the SPY zero DTE Iron Condors, and I like them at around 16, 17, 18. VIX or something like that. When it's too low, I kind of stay away. It's just, it's hit or miss. That's when you start really picking, you're trying to pick up nickels and pennies to, and all of a sudden one day you lose 50 cents. You're like, I just messed 2 weeks. So you're doing well for 2 weeks. So, I do like when there's some volatility. I don't like a trending market like we're in, where it's just going straight up. I try to stay away. I'm looking for, days where it's normal. It's up, it's down, it's up, it's down. That's kind of what I'm looking for. I'm also looking at volume at different places. And so if we're in a range and there's deep volume in that range, then sure, as long as we don't break out. And when we break out, then I know that all of a sudden it's going to start trending for a week or so. So
Yeah.
I'm looking for those ranges, and I'm looking for time to be, in the zero DTE or within 1 week. You get paid more with 1 week, and you can get wider spreads. But I'm usually more short term. Some people do it longer term. I'm more of a short term type of guy.
Let's say the market conditions are correct. You said you like to trade SPY, zero DTE, iron condors. What percent of profit are you looking for before you exit?
It's a good one. So this is where, again, if you're doing it automated, or you're back testing, you know, I don't try to take out the whole thing. I think you can make decent money, just putting something on early in the morning, and then right around early afternoon, 12 to 1 o'clock, you kind of say, all right, where are we? Somewhere between early morning and 12, there's a high percentage chance, each day, that you can take out something, and without being too egregious, just 20 to 40%, if you want to get to 70% and 80% gains, you're gonna have to. These things stick around, especially in the trending market. It's not like they're going to give it to you. You make the most money at the very end, right? You make it quick. It goes quick at 3:30 to 4 if you're not by strike. But if you are near strike, it also goes from 50 cents to $3 quickly. So, I think that people have caught on that early in the mornings, some of the volatility is high. The market makers make it high as the buyers are coming in to make those leverage bets. You could sort of lean into that a little bit, 9:30 to 10 o'clock. And I mean, but in an hour and a half, if nothing is happening, these things shrink by, you can make 20, 25%.
Yeah. When you've got, because it's 4 legs that you're putting on, right? 2 calls, 2
Yeah.
puts. Are any of those where you are, let me just kind of totally blanked on my question here in itself as well. I have no idea what I was going to say. I've been doing this for a year and a half with you, and I've never lost a thought of what my question was going to be. So I want to, got it.
There you
Sorry.
go.
You've got 4 legs, right? Are you ever in a position where you have traders that try to be cute and like close one leg? I know you talk about your strategy, but is that a mistake that traders often make, where trying to be cute with, something's going to
Yeah. You can run into a little bit of trouble there. I mean, the strategy is supposed to be take it off, when you take it off when you put it on at one time, you take it all off at the same time. People do try to be cute where it goes down to like one leg, and then they'll take off the upside, right? So they'll buy back the upside for, so they'll take a profit there. It's everyone's going to do it differently. There's so many different variables to this strategy that I would say if it gets down to like 10 cents, or a very small amount, okay, fine. But if that happened, then you're probably close to the end of the day, or the thing has gone way into the money on the other one, and you got to start. Really, the one that you're supposed to be managing is not to buy back that one, is the one that is probably starting to become in the money and starting to become a little bit of a problem.
I just remembered the question. With it being 4 legs, I assume this is a defined risk trade, right? Where It's like whatever you've put in, you know exactly what you're going to lose, you know exactly what your profit's going to look like, and all that. There's no surprises when you get a margin call at 401.
Yeah, so the way you look at it is you can say an iron condor might be, a $5 put spread and a $5 call spread. And you're going to collect on that, let's call it 75 cents, 80 cents, something like that, depending on which strikes, right? So if you have $100 stock and you're looking up and down, you can just see, okay, I sell this one, I sell that one, $5 on both sides. I can only lose $5. The stock can't be in both places at the same time at the end of the day. So I can only lose $5. If it goes way through the upper strike on the call, or it goes way down of the lower strike in the put. Now, how much am I going to get paid? So if you go further out of the money, you're going to get paid less for that $5. If you go closer to the money, you will get paid more. Okay, but again, you get paid more chance of risk that you're going to go through one of the higher legs. So it's $5 spread, and what I want to collect, something like $1 to $1.50. So if $1 to $1.50, where are those strikes, and you look and you can sort of see the range. Some people then look at technical marks and they say, okay, well, if it can only get through the upper range if it broke through this moving average, and this is yesterday's low, and I want to lean on that. So they might structure it around there. You can move the strikes. You don't have to have it evenly around, the stock. So it could be the at the money put spread down, especially if you're leaning long, or say I'd like to lean long with an iron condor. You can use the strikes to actually take in more premium.
Yeah. I was looking at the markets here to see if we can find just an example of, opportunity. So like obviously in the morning, like you mentioned, whether it's going up or down, there's quite a bit of volatility. Usually buyers are still trying to figure it out. Would you say lunch? I know you talked about in the morning, you put on a trade, and if it dies down in terms of, the volatility, the movement, that's where you can go to capture 20, 30, 40%. What would you say to individuals that might believe that lunchtime is a great time to go ahead and put this on, since there's not a lot of movement? Obviously right now, in the past 30, 40 minutes, we've kind of been in this range, slowly poking above. But what are your thoughts on that? Like lunchtime being a time
So
frame, something like
yeah,
that.
so I would say that a lot of the day's over, and so the whole part about the iron condor is the implied volatility and sort of what might happen if all of a sudden the market does what it did here. It looked like it found its range. The price that you're going to take in, the amount you're going to take in, is probably not that much,
Mm,
because the market's already found its range, right? So the whole point is that it's the mystique of where is it going to go today has the elevated implied volatilities in the morning. So if you did it, I could tell you right now, if you did it at 9:45, right after that first move over there, 10 o'clock,
yeah,
people right in that beginning is where you get paid the most, because nobody knows where it's going to go today, without having some idea where it might go.
yeah.
But if you did it, you see that first half hour,
Hmm.
I don't do it any time in the early morning, like 9:31, 35, but you wait a little bit, maybe on that first move, even if it could still go up. But if you would have sold it with the cues at around 679, 680,
Hmm.
that trade be up, I'm sure, probably about 25% right now, 20%.
Yeah. And how far apart do you like your strikes typically?
So it depends,
Let's just take
you
the
can
SPY,
use,
for example. Let me
yeah,
go
it
to the
depends
SPY.
on the percentage of the move, but you can look at, 1%, 1%, a half, let's say a half to, it depends on the implied volatility, but you can start looking at strategies like, for example, if there's a 16 IV, right? If the
Yeah.
underlying asset is 69 V, what is the market saying? The move each day is implying for the move each day. You just divide by 16. So I use 16 because divide by 16 is 1%. So
Yeah.
you can take strikes that are between that 1%, right? That are like, you know, the 1% above and the 1% below is in the middle of your strikes. That way you're getting paid a little bit for the risk that could happen, but you're also within the range that the implied volatility um is 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 being given.
Yeah.
Does that make sense?
Yeah.
It's like if you go way too far, if you go too far out, you just don't get paid a lot. You're literally picking up nickels, and you'll win like 95% of the time. But
Yeah.
it's that one time that the market just goes straight up 1.5%, and then all of a sudden it's like, oh, you just got smoked for the last 6 months.
Yeah. No, nobody wants to be in that situation. Um, Whenever you set you talked about how wide you want your strikes. The further out the strikes go, I assume the less money you will make because your bet is hedged with a wider net. Does that make sense? And is that
So yeah,
correct?
again, it's a remember, it's a math formula. So you will win a greater amount of times the further you go out, but you're going to win less dollar amounts. Okay, so it's like, which bet is best? 90% win, and you win 10 cents, or 30% win and you win $1. It's going to be the 30% win and you win $1, right?
Yeah.
It's just the math of how you do it over the time. But so that's what you're doing. So when you're looking at these these iron condors, it's like I can win 90% of the time, I'm going to make 10 cents, or I can win 75% of the time and I'm going to make 20 cents. Which one's better? The 75 to make 20, right? So
Yeah.
that's how you have to look at it. You have to think about it that way, and you got to find that middle ground of where you want to be, and then you have to decide whether you want to do this risk management. Some people don't do it. There was a whole group, um eventually they blew up, but there was a whole group that never, they were doing the SPX, and it was all cash settled, so they just knew it was either going to win this or it was going to lose that, and I'm going to leave it to the end of the day. There's no need to exercise. There's nothing I have to do. I don't have to close it, um and it'll just go to cash. So they would take in about, I think it was about 20%. So if $5 spread, they would take in $1 and let it ride, right? And they were successful for many times. They also did this part of the strategy was Martingale, where they would double, and if they lost, so if they lost, they would double. If they lost, they would double. And I think they lost like 6 times in a row. And I think the main guy, it was all over the news. He lost millions, maybe tens of millions. The group as a whole was getting bigger and bigger because over 6 years they were doing amazing, right? Literally over 6 years they're making so much money, and they lost everything in 6 days. I think it was not this Christmas. It was it might have been this December. Might have been this December, the story. So there's stories of iron condors. So that's, you can't be doing the Martingale strategy, which is basically doubling and doubling. You lose, you double. It's like playing blackjack, black, 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 doubling, 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 hit 16 times in a row, and that's it. You've lost $1 billion.
It works until it doesn't.
Right.
This is pretty much it. Felix, any final thoughts on iron condor, the market in itself, or anything like that at all?
No, I mean, I think the iron condor is a legit strategy. I think that you could make money. People should get comfortable by back testing, and there's so many many sites that offer back testing an iron condor strategy, in the morning, all the different times that we talked about, whether it's 2 days, 3 days, whether it's you can do, we didn't talk about it, but you can do the wings, could be the farther out wings could be, say, 1 week, and then the inner strike could be 2 strikes, could be like 1 day, and you could do that each day. There's all different variables, but the key thing is it's a little bit of a math problem, especially the zero DTE, because you're just going to do it each day, and finding that right time and the right risk management is key. I think 9:30 to 10 probably the best time, and try to avoid the end of the day.
All right. Felix Frey, thank you so much. I appreciate your time here today.
Take care. Thank you.
Thank you, folks, for joining. We'll see you next week.